welcome back to the channel. Thank you for tuning in. So guys, in today's video, I will talk about the market. I'll talk about the ICT market maker buy and sell model. So I'll talk about the ICT market maker buy and sell. Not buy and sell as in like hedge, but buy and sell model, because sometimes it's market maker buy model, sometimes it's market maker sell model. So that's why there's an X. So it's can either be a buy model whereby we're expecting buy side price delivery, or a sell model whereby we're expecting sell side price delivery. So the market maker X model, it is the end result. If you let me say this, it is the end result of 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 our strategy as a whole. I'm not hyping it up, but I want you to appreciate what I'm about to share with you, because what I'm doing right now is that obviously this is if I'm being honest, this is for me, right? This is for me. I'm trying to get this on record for myself, but I might as well share it with you guys, right? And share it with you guys, and okay. So the time currently is 12:19. We're 90 minutes inside the lunch hour. So as you can see, the lunch hour is divided by my Saturday. So anything prior to that would be the New York AM session, right? I'm looking at Euro USD. With the Euro, we don't have a PM session, so lunch hour, you can be out of the market unless, of course, if there's fundamentals or manual intervention coming in later today. If there's that, maybe it might move. But unless if there's news coming in, oh no, oh no, there's FOMC today. Wow, wow. Yeah. So unless if there's this, then it will move in the PM session, right? So anything before that is New York AM session. For me, the New York, I'm being advanced right now. So as you might have noticed, if you have on this channel, I don't waste time, guys. I'm advanced. Obviously, I do acknowledge that a lot of you who are new to this channel, you are new to these concepts, and what I'm trying to do by being advanced on you is that I'm trying to like quickly save you some time if that's possible, right? So I'm going in with the market maker X model. This is the highest. This is basically all of our concept combined. Because if you look, like I said, 7 o'clock starts. 7 o'clock starts the New York AM session, right? Now from 7 o'clock to 9 o'clock, that's a silver bullet for the forex market. So when you are looking at the market maker X model, you will find that things like silver bullet, OTEs, optimal trade entries, model 2022, all those entry tools, they are small segments of the market maker buy and sell model. Before I begin, I remember talking about the analogy of a candle. So every candle, you might already know this, every candle, it will open It will open there, print the low of the candle. In other words, print the Judas move. So the protraction stage of the candle that's printed by the Judas move. And then we'll have the high of the candle, then the retracement into the close. So every candle will open, print the low, dynamic imbalance, high of the candle, retracement back into the low. So with that thinking, every session is like that. So in retail, you know there's trading sessions, you know there's New York, there's London. But what does it mean to you as a trader? A lot of retail traders may not be aware of that. So what the New York session or every session, what it means to institutional traders is that as soon as the session opens, they will anticipate the algorithm being in some sort of protection stage. In other words, the Judas move. They will anticipate. So if they're expecting a bullish move, they'll anticipate, the low of the session being formed, dynamic imbalance, the high of the session being formed, and then a retracement into the close. So with that exact thinking, I would like to introduce you to the ICT market make X model, whereby we will have, so from 5 a.m. to 7 a.m., that marks the London lunch. So during the London lunch, we see a consolidation. So that consolidation, we call it original consolidation. It is the starting point of the market maker X model, buy model in this case. So below this low, these two lows, these equal lows, these relatively equal lows, below these lows, there is liquidity resting below those lows. So we call that sell side liquidity. So the algorithm will trade and engage with sell side liquidity so that institutional minded traders can, you know, buy those sell stops. So when traders that were buying this, they'll have their stop loss um in this move. When traders that were buying this, they'll have their stop loss below this low. So when that stop loss gets engaged, there's a trader that's buying that. In other words, when smart money is preparing to push this higher, they will first engage sell side liquidity, consolidate it, and then break out of consolidation. So how do you know that this is a consolidation? Well, it looks like a consolidation. It's going sideways. Can you notice that from the highest high there and the lowest low there, the market is literally just moving sideways? You can see that it's moving sideways, right? Now, it leaves the original consolidation there. Can you see it gapping above there? It doesn't close above using this candle, but it gaps above. So that gapping above is a small signature in price that, we've left original consolidation. So when we come back to it, that's a return to original consolidation. So it leaves original consolidation there, and then it comes back to return to original consolidation. But what is actually happening is that the algorithm or price is just trading back to this favorable gap. Can you see this favorable gap? The algorithm or price is trading back to the opening price of these consecutive candles. In other words, this bullish order block. So that's a return to original consolidation. What does the market do after that? It breaks higher. It breaks higher, leaving this fair value gap. Can you see this fair value gap there? Okay, let me just quickly remove this because I don't know what it is anymore. This fair value gap, can you see it being used as some support level? So it's finding discount inside the fair value gap. Can you see it? It doesn't even trade below the fair value gap at any point. Now I'm just gonna remove the fair value gap for the sake of simplicity, but because I wanna take your attention to 7 a.m. here. Do you have to be trading during the London lunch? No. The fact that it's lunch tells you that you should be resting during that time, right? What time does New York start? New York starts at 7 a.m. for me when I'm looking at the forex market, right? So as soon as 7 a.m. hits, what do you look for? You look with that same thinking I try to explain. As soon as 7 a.m. starts, you look for a protection stage. In other words, you look for a Judas move. So you look for a move in the opposite direction to what you basically anticipate. So if you're bullish, you would look for a move going lower. Why? Because you want sell side liquidity to be engaged. Why? Because if you want to buy this, the best buys for you, the highest probability buys, the easiest um, low risk, low drawdown buys are going to be after um, a stop rate. So after liquidity has been taken out, in other words, after we trade below this equal lows, triple bottom in this case, that's even worse. Some stops are resting right below these lows. So you wanna buy those stop losses up for a what? For a turtle soup. So right then at 7 a.m. you could be buying that for a turtle soup. So every time you see an X marked on my chart, I'm indicating a turtle soup. So you can literally buy that. Buy this turtle soup. Stop loss below the candle that left this imbalance there. This gap there. I'd be confident putting my stop loss below that. So in other words, something like this would make sense for me. Now, that's just one out of a million trading opportunities you can have when you're trading the what? The market maker buy model. Because remember, you could have, assuming that you're not trading, or assuming that you are able to see this, you could have entered the first buy there, right? The return to original consolidation. That could be your first buy. We have a fair value gap created. What time is the fair value gap being created there in price? At 7:12. It comes back to it, it finds support. Now, at the start of the video, I told you that silver bullets are a small section or a small portion of the market maker buy model or sell model. So this fair value gap formed at 7:12. That's a silver bullet fair value gap. Trace to it there, you buy that. It gives you a second chance there. Trace to it using this candle, you can buy that. Now you know that silver bullet is not meant to be a big trade. It's meant to give you 10 pips. So do we get 10 pips? Let's find out. Okay, assuming that you're new to this concept, so you're gonna buy at the top of the fair value gap, right? As soon as it enters. Stop loss, you can be confident putting it below this low, or put it above or below the candle that forms the fair value gap. Then you're targeting what? 10 pips. So if you're buying there at 0783, 10 pips would be 93. Where is 93? Trace to it there perfectly. Look at the body staying below 10 pips from your entry. It's not a coincidence. Now, silver bullets is not meant to be a big trade. Just 10 pips and then you're done. Right. Um, we can see that after your silver bullet, price creates this fair value gap whereby it finds creates this fair value gap, trades below it, it finds resistance. Now it does trade above it there, but that's fine. It finds resistance within this fair value gap there. You can even see it after it trades below it one more time, it goes back there, finds resistance, and then it breaks lower. Where does it go? Anyone who's trying to buy this, when they see this low, they'll attempt to put a stop loss below this low. Why? Because every book tells every trader to put the stop loss below all lows. So the algorithm will trade below, this low for a what? For a stop rate. Now, balance price range. I've mentioned this many times. Zoop, zoop. This bearish fair value gap, bullish fair value gap, this CB, this BC, within the same price point. That is a balanced price range. It is the only PDRA ICT hasn't taught up until recently. So from this, I don't know why this thing got removed, but from this sell side liquidity below this low to the low formed here, that is a trapped trader. So the smart money traders, they will see this guy there as a trap trader. The reason they see him as a trap trader, or the reason they call him that, is because when price was trading lower, creating this imbalance lower, the traders that were seeing that and selling that aggressively without logic to their trading, or the trader that sells on breakout, they'll see that and then they'll sell. The algorithm will quickly, trade above this low there, leave a fair value gap, and leave it unfilled. So what is that? That's a breakaway gap. So how do you know if a fair value gap is going to be left unfilled? I just taught you. So they will quickly run away from this guy. Make sure they hit him as soon as possible by leaving this gap unfilled. Run away. This was on a 5 minute. Let me show you how it looks on a 5 minutes. So the difference between the close of this candle and the opening of that candle, that is called an opening gap. So if I go on a lower time frame, like a 1 minute, still this gray area there. So you can see price, it trades above there and then comes back and finds support inside the gray area. Bullish order block, the opening price of this candle. As soon as price trades above this low there, it confirms that it's inside a what? A buy program, meaning it's delivering what? Buy side price delivery. So as soon as it prints a red candle, when it trades above the opening price of this red candle, that is a change in the state of delivery. So that's a bullish order block. It trades to it there. This small trading below that line there, that's a mohawk. The mohawk is simply it's simply a small deviation in price between what would be compared as perfect price delivery and what we actually got in price. But what is actually happening that price is filling this gray area, it's completely filling it with the wick. Can you see that? What does it do after that? It runs away. Now, these candles, the opening price of that candle, sensitive. As soon as you see price trade above it there using this candle and leaving a favorable gap, when it comes back to it, you expect the opening price there, the change in the state of delivery, you expect price to find support. Can you see it finding support there? The opening price of this candle, you're looking at this O figure over here. The opening price of this candle comes in at 107889, while the low of this candle, looking at the L there, the low of this candle comes in at 1079 107889. The open there 07889, low the L there, the low 107889, the open there, the O there 107889. That is perfect price delivery. So that is perfect price delivery. That's what you call perfection at its highest. What does it do after that? It runs away. Creates this favorable gap, comes back, finds support. What time is that happening? It's happening between 7 o'clock and 9 o'clock during the what? The Forex silver bullet. Runs away from that. Favorable gap, comes back, finds support, runs away. We have a high there, second high, third high. Even the candles, we have a high, second high, third high. When you see something like that happening, anticipate smart money reversal bearish. What does that mean? It means that price is now in what? Sell program. From this high there, sell program. What does it do? Immediately after that, it opens, brings the high of the candle, and then breaks low. Confirms the sell program by leaving what? A favorable gap. We have a swing low there, with the previous high there that got taken out, swing low that gets taken out with displacement. Displacement means magnitude, magnitude means favorable gap. So what is that? That is a market structure shift, bearish. It's the confirmation of a sell program. So I made a video on this this logic I'm speaking about now. Model 2022. Even ICT has a whole mentorship on it. Favorable gap there doesn't trade to this favorable gap, but there's a favorable gap there. It trades to it using the high candle. Now, if you don't have, if you don't have a best broker, you're not gonna get that fail. But you can see it's manifesting in price. It runs away. Now, as you can see from this line there, I have buy side and sell side. What this means that from this line there, anything on the left is buy side price delivery. Anything on the right is sell side price delivery. What that means that on the left I was bullish, on the right I'm bearish. So when you see someone talk about the ICT market maker, when you see someone talk about the ICT market maker X model, the X simply stands for buy or and sell. So what that means that on the left, I was talking about the ICT buy model. On the right, I am now thinking about the ICT sell model. So the difference between the ICT, what separates them, that end sign, if you will, that is what? That is the smart money reversal there. The separation between buy side and sell side price delivery. Hence, smart money reversal. So this trading back to this favorable gap, I can see that as a low risk sell. So I think I'm tired now, guys. I've been speaking for a while, hence I'm biting over my words. So that's a low risk sell. That's a low risk sell right there. Now, on this side, on the buy side, on the buy side of the curve, this red candle, it would have normally been a bullish order block. Like here, trades above, expected to find what? Support. So it would have normally been a bullish order block. Now that I'm on this side of the curve, that changes. So that is what? It's normally a bullish order block. It becomes a bearish order block to me. So this is the only time when I'm looking at the market maker X model. This is the only time bearish order blocks are red. I made a video not so long ago on order blocks, and I told you that order blocks, bullish order blocks will always be red, and bearish order blocks will always be green. When I'm looking at market maker buy model, or when I'm looking at market maker models, this is the only time a bearish order block will be red. This is the only time a bearish order block will be red. Yes. So this what this means that normally I would mark the bearish order block, the bullish order block. I would mark it at the opening price. But if I'm marking same candle, if I'm marking the closing price, is a bearish order block. So as soon as it trades below this candle, it finds a resistance where at the bearish order block, which is red. No one else will teach you this here in South Africa. No one else. No one else. So price, it breaks away from that, runs away. Here's a normal bearish order block. It finds resistance inside the bearish order block. It doesn't trade to the opening price there, but that's fine. Now the difference between this candle and this candle, that's a fair value gap. So the difference between these two candles, that separation, that imbalance in price, the algorithm will identify this imbalance in price and then trade back to it there. You see that. So it trades back to it there. You see that the bodies are staying below it. So it will break down from that. Fair value gap, trades back to it. Now, how the market maker buy and sell model completes itself is that I'm looking to see where is original consolidation. Here is it. So the low below original consolidation, I will mark that. I like to call it original consolidation low. Original So what this means is that when it was going up, when it kept on going up, there were traders that were buying this. So while it was inside a buy program, while we inside the buy side of the curve, every trader who was buying this, they will have their stop loss below this low. Every trader who was buying this from even the first candle day, they'll have their stop loss below that low. So that's what we're targeting right now. Where is it going? It's below. It's going to original consolidation sell side. Double top that you saw at the beginning of the video gets traded to. From the swing high to the swing low there. Can you see this? From the swing high there to the swing low there. Price trades to where? 70. You can sell that. It does trade above, a little bit above 79, but it doesn't trade to your stop loss. That's very important. It doesn't trade to your stop loss. So on this day, it did trade to 79 and a little bit above. Stop loss above this high. Does it trade to a stop loss? No. 1, 2, 3. What is that? 3 thrust pattern. I made a video on it. I made a video on it. 3 thrust pattern. 1, 2, 3. Thrust pattern. Signal there. After buy side liquidity above this high was taken. So what is that? It's a market structure shift. Bearish. That's a market structure shift. Bearish. So where do we retrace into? You retrace into the 750 spot. You can sell that. That's retrace there for the first time. Go down. Come back. Test. You shouldn't get scared. You should keep on selling it. The more it comes back to 79 to 70 level, the more you sell. You don't get scared. Where are you targeting? Original consolidation sell side. I've shared enough, guys. I've shared enough. Even the live environment, you can see that. Obviously, now it means that I have to wait before I can speak. But you can see that it's trading towards sell side there. It's creating a favorable gap there. It traced to it there. Do you remember that volume imbalance, this gray area? So remember we were using it as a buy entry at some point. Right there, you can use it as a sell entry and be confident that price will trade to your target.